Hello and welcome to part 13 of the subject basics of accounting. Now, in the last session, we had finished the meaning of trial balance. Why is it called trial balance? The methods of preparing trial balance, forms of presentation of trial balance. Now, in today's session, our focus will be on end of the accounting period adjustments. As mentioned there, adjusting entries is a prerequisite for final accounts. Remember this. If we have a good knowledge of adjusting entries, we can easily and smoothly prepare final accounts. Now, this concept of adjusting entries will help you to prepare final accounts of not only, I should say, a sole proprietorship business, but also of partnership, or for that matter, company as well. But in case of company, there is a slight change because we don't prepare accounts. We prepare statements as far as its final accounts is concerned. So this concept of adjusting entries is the basic, and it will be of great help to all the learners of this particular subject. Now, what are the topics that we are going to cover in this particular session? We are going to learn as to what do you mean by an adjustment. I will present to you the list of adjustments which we are going to cover, and finally the adjusting entries. Now, what do you mean by an adjustment? See, when we are doing our final accounts, trial balance is readily available to us, as we have seen in the last session. Trial balance is readily available. Along with the trial balance, we will be given some items as adjustments. And trial balance and adjustments put together, you may have a question, prepare final accounts. Now, what are these adjustments? Trial balance are those items which have gone through the books of accounts. Balances are available in ledger accounts, and those balances are now brought in a statement called trial balance. Then what are these adjustments which are given outside trial balance? So adjustments are nothing but items which have not gone through the books of accounts at all, and which requires the fulfillment of double entry principle at the time of preparing final accounts. So both the debit and the credit aspect of such transactions have not been recorded in the books of accounts. And when we are preparing final accounts, these items are to be adjusted. That's why these are called as adjustments. So once again, let's understand the meaning. Adjustments are those items which have not gone through the books of accounts at all, and which requires the fulfillment of double entry principle at the time of preparing final accounts. So these items are called as adjustment. That means to say, every adjustment will have two effects. All trial balance items will have only one effect because it has gone through the books and it has reached this stage. Whereas adjustments has not gone through the books, and that's why to accommodate that, to include that in final accounts, you will be giving two effects for every adjustment. And in that two, one will be a debit effect and the other will be a credit effect. So these are adjustments. Now let's look at the list of adjustments. So if you look on the screen, there are some adjustments that are recorded in red, and there are other adjustments which are in blue. Now, the meaning of this is simple. I'll be covering these many adjustments in this 13th part. Part 13, we are going to cover this 4: closing stock, depreciation, outstanding expenses, outstanding income, and something which is very close to outstanding income, that is accrued income. There is a slight difference between outstanding income as well as accrued income. So we'll look at these 4+1 items in today's session. Very important point that we have to note. All these adjustments that you see on the screen, will be included in the books by passing what is called as adjusting entries. So we have learned, remember, subsidiary book, journal proper. Where do we record adjusting entries? Not in purchases book, not in sales. No purchase return, no sales return, no cash book, no bills receivable book, no bills payable book. So only one book among the subsidiary books is available to record adjusting entries, and that book is called as journal proper. So adjusting entries will be recorded in journal proper. Let's look at the first adjustment. The first adjustment is closing stock. As we know, stock means something which remains unused, something which remains unsold. So stock of goods unsold at the end of the accounting period is known as closing stock. So if I'm doing business in the year, say 2021, starting on 1st of April 20, ending on 31st March 21, what is the value of stock or goods, or even you can say raw material that remain unused, that remains unsold at the end of the accounting period, that is called as closing stock. This year's closing stock will become next year's opening stock. Understand this rule very clearly. So presently we had focused on closing stock. Stock of goods or materials unsold or unused at the end of the accounting period, that is called as closing stock. Now, very, very important one. As I said, this year's closing stock will become next year's opening stock. Similarly, last year's closing stock will become this year's opening stock. So opening stock of this year plus purchases of this year, if we add this number, opening stock at the beginning of the year and purchases during the year, there is great relevance of this particular number. When we add both opening stock and purchases, we get one number. Now, what is this particular number? Understand, this number which you see, it includes closing stock. This number which you see, let's say for example, the opening stock value is 50,000 rupees. Purchases during the year, let's say, is around 1 lakh rupees. So total cost of goods available for sale, which is this color red, is 1,50,000. Out of this 1,50,000, let's imagine 1,10,000 worth goods at cost is sold. Meaning to say 40,000 rupees worth goods remain unsold. And that's why this particular number, that is cost of goods available for sale, this number in red, it includes closing stock. And since it includes, it is inclusive of closing stock usually is not shown in the trial balance. But there is a twist in the tail as far as whether closing stock can be shown in trial balance or not. But understand this, this number which you have in red includes closing stock, because opening stock and purchases during the year is the total value of goods available for sale. Out of that at cost, part of the goods are sold and the remaining part which remains unsold is closing stock. That means this number includes closing stock. So closing stock is usually not shown in the trial balance. Now, when I say it is usually not shown in the trial balance, what does that mean? We get to find the formula called cost of goods sold. Cost of goods sold. This is basically cost of goods available for sale. So what is cost of goods sold? We have opening stock. Then we have net purchases. I have written the word net. Net purchases means purchases minus purchase returns. Or you can say gross purchases minus purchase returns will give you net purchases minus closing stock. Minus closing stock. So when we say minus closing stock, this cost of goods sold, remember stock is unsold. So cost of goods sold excludes closing stock because this is unsold. And this number is basically, you can treat it as cost of goods available for sale and part of it is sold. Closing stock is excluded and that gives you what is called as cost of goods sold. So what remains unsold is closing stock. Let's understand further. What are the entries that we pass in the books? Now there are two entries that you see on the screen. On the left side, this is more so a transfer entry. Last year's closing stock, which is this year's opening stock, is transferred to trading account. And the journal entry for transferring this year's opening stock will be trading account debited to opening stock account. Whereas this entry that you see on the right is an adjustment entry. And that adjusting entry is journal entry for closing stock at the end of the accounting period. And that entry is closing stock account debited to trading account. So this is basically the adjusting entry for closing stock. So stock is an asset. So closing stock account debited to trading account. So stock account is debited. Now, one more very important point I've already mentioned when I was explaining about, say, important terms in accounting. I had mentioned that we don't open an account called goods account. Goods is known in the books of accounts as purchases account, sales account, purchase returns account, sales returns account, opening stock account, closing stock account. But in that internal, another point, we don't open a separate opening stock account and closing stock account. It is simple. Stock at the beginning of the year is called opening stock, and stock at the end of the year is called as closing stock. So there is only one name given, and that is stock account. At the beginning, it is called opening stock. At the end, it is called as closing stock. So the entry would be stock account debited to trading account. So this is what will be the adjusting entry. Now let's understand this basic question. Can closing stock be given in the trial balance? This is a major question that all commerce students should answer. Can closing stock be given in the trial balance? We spoke about closing stock being shown as an adjustment. So I'm coming to an altogether different question. Can it appear in the trial balance? And the answer to this question is yes. Closing stock can appear in the trial balance, but you won't be given opening stock. You won't be given purchases in the trial balance. Rather, you will find items like adjusted purchases, cost of goods sold, and cost of sales in the trial balance. So point to note, if closing stock is given in the trial balance, then we will be given with either adjusted purchases, cost of goods sold, or cost of sales in the trial balance. So the item names will be these. Item name will not be opening stock. It will not be purchases. Remember this. Rather, it would be adjusted purchases or cost of goods sold. We just saw the formula of cost of goods sold. Opening stock plus net purchases minus closing stock. So when I say minus closing stock, cost of goods sold excludes closing stock. So closing stock will appear in the trial balance. Similarly with adjusted purchases, similarly with cost of sales, the meaning is same. It's opening stock plus net purchases minus closing stock. So if these names are given, then closing stock will surely appear in the trial balance. Now, what is the application of closing stock? So as we have learned, closing stock may either be given in the trial balance or may be given as an adjustment. Remember, all trial balance items, you will give only one effect. And if closing stock appears in the trial balance, remember it is stock unsold, which will be sold next year. So closing stock, if given in the trial balance, will appear simply on the asset side of the balance sheet. But if closing stock is given as an adjustment, we have learned every adjustment will be given two effects. And one of the effect for adjustment will be on the credit side of trading account. We just saw that entry. The entry was closing stock account debited to trading account. So trading account is credited. This is the adjusting entry that we are speaking about. Another effect, as you see over here, will be asset side of the balance sheet, because this stock which is unsold this year will become opening stock at the beginning of next year and it will be sold. So this is the treatment of closing stock. If given in the trial balance, only one effect, and that will be on the asset side of the balance sheet. If closing stock is given as an adjustment, then two effects. One will be on the credit side of trading account, another one will be on the asset side of the balance sheet. So this is about the concept of closing stock. Let's move to the next adjustment, and that is depreciation. A very important and a very interesting adjustment that we have. No matter you solve final accounts of maybe sole proprietorship or partnership or company, this particular concept is the most common one. Depreciation. What is depreciation? Depreciation is nothing but a measure of the value of fall of value of fixed assets. So fixed assets value is going to decrease, and that value, by how much the value of fixed asset decreases, that value is called as depreciation. So I can go to the extent of saying depreciation is the estimated cost of the expired usefulness of an asset. Point to note, it is only an estimated cost. It is not an actual cost. It's an estimation. We cannot say machinery value has gone down exactly by 2 lakh rupees. Machinery value might have gone down by maybe 1,90,000 rupees or 2,10,000 rupees. So that 2 lakh rupees is only an estimation. And this estimation cost is associated to expired usefulness of an asset. Suppose we purchase an asset and say we make an estimation that we are going to use this asset for 8 years. When the first year is over, the utility of the asset is now only 7 years because 1 year has expired. At the end of the first year, 1 year has expired. To that expired period, we attach a value, cost, which we call it as estimated cost, and that value is called as depreciation. Now, what is the adjusting entry for depreciation? Depreciation is a non-cash expense because business is deriving a benefit out of the use of an asset. Say, for example, machinery is used, furniture is used, motor car is used. So you cannot call depreciation as a loss. Second, you cannot call depreciation as an expense as well. Why? Because salary is an expense. You pay salary to the employees. Rent is an expense. You pay rent to the landlord. Insurance is an expense. You pay premium to the insurance company. Audit fees is an expense. You pay fees to the auditors. But depreciation, you don't pay any money to the asset. But business is deriving benefit. That's why depreciation is called as a non-cash expense. So debit all expenses and losses. So depreciation account is debited to asset account. When we are depreciating, asset value is going to decrease. So decrease in value of asset account is credited. That is the American rule application. So this is the adjusting entry for depreciation. That is depreciation account debited to asset account. Question again. Can depreciation be given in the trial balance? That is also a question to be answered. Once again, the answer to this question is yes. If depreciation is given in the trial balance, point to note, if depreciation is given in the trial balance, then that assets which are shown or given in the trial balance are after depreciation values, or we call that as post-depreciated value. So if depreciation is given in the trial balance, then the assets given in the trial balance are post-depreciated values, meaning to say after deducting depreciation. So assets which are given, if depreciation is given in the trial balance, whichever assets are given in the trial balance, those assets values are after deducting depreciation. So if given in the trial balance, meaning to say you will have only one effect. Asset values have already been deducted. Let's look at the application. So depreciation can be given in the trial balance. I just mentioned. If it is given in the trial balance, only one effect. Asset values have already been reduced by the depreciation amount. So the effect would be to show it on the debit side of the profit and loss account. If it is a manufacturing asset and depreciation, it would be debited to manufacturing account. Understand that. So in the absence of manufacturing account or manufacturing business, depreciation on assets will be shown in the debit of profit and loss account. So if given in the trial balance, only one effect, and that will be on the debit side of profit and loss account. Now, if depreciation is given as an adjustment, normally you'll be given with this, we will have two effects. The first effect will be as usual, as you have understood, debit side of profit and loss account. And the second effect will be deduction from assets in the balance sheet. So if depreciation is given as an adjustment, point to note, every adjustment will be given two effects because adjustments are items which have not gone through the books of accounts at all, which requires the fulfillment of double entry principle. So two effects will be given. One will be debited to profit and loss account, and second will be deduction from asset in the balance sheet. So this is about the concept of depreciation. Let's move to the third concept in the list of adjustments, and that is outstanding expenses. What do you mean by an outstanding? Simple point, expenses which the business had to pay, business has not paid, it is payable. And since it is payable, outstanding expense is a liability for the business. So expenses remaining unpaid at the end of the year are known as outstanding expenses. That means the business has to pay. Now, if you have to find the current year profit or loss, it is very, very important that this outstanding expenses are included in our profit and loss account, because this is relating to current year. Though we have not paid, It is relating to current year. So it must be shown in our current year profit and loss account. Now, as I mentioned earlier, business is supposed to pay. Business has not paid, meaning to say it is payable. Since it is payable by the business to outsider, it is a liability because its payment is likely to arise in future. So outstanding expenses is a liability. We have discussed this siblings under the concept of siblings of accrual concept in part 4 of this particular subject, basics of accounting. So you can refer back. So once again, outstanding expenses is a liability because its payment is likely to arise in future. And since outstanding expense is a liability, point to note, increase in liability is credit. So outstanding expenses is a liability. It will be credited. And concerned expenses value will increase. So concerned expenses account debited to outstanding expenses account. This is the adjusting entry that we have for outstanding expenses. Now, once again, a question, can outstanding expenses be given in the trial balance? So we need to think. Again, answer to this question is yes. Outstanding expenses can be given in the trial balance as well. But when it is given in the trial balance, what does that mean? It simply means that the concerned expenses, to the concerned expenses, these outstanding expenses are already added. We don't have to add it once again in the profit and loss account. So if outstanding expenses are given in the trial balance, it simply means that this outstanding expenses amount is already added to concerned expense. That is in the profit and loss. It's already added when the item is given in the trial balance. So we don't have to add it once again. So it will be given only one effect. What is the effect? We will see now. Let's look at the application of outstanding expenses. So if given in the trial balance, as I mentioned, only one effect. This outstanding expense is already added to the concerned expenses, so that other one effect that is available, that will be shown on the liability side of the balance sheet. But if it is given in the adjustment, you know very clearly you will be giving two effects, and one effect as usual will be, it will be added to concerned expenses on the debit side of profit and loss account, and second effect will be shown on the liability side of the balance sheet. So this is about outstanding expenses. So if given in the trial balance, only one effect, that is liability side of the balance sheet. So as I mentioned, if given in trial balance means concerned expenses value, outstanding expenses is already added to that. We don't have to add it again in profit and loss account as we do it here if it is given as an adjustment. So only one effect, and that is on the liability side of the balance sheet. But if it is given as an adjustment, you need to add it to concerned expense on the debit side, and also you need to show on the liability side of the balance sheet. So this is about outstanding expenses. Let's move to the next concept, and that is outstanding income, exactly opposite of outstanding expenses. I stress on the word income earned and this particular word in blue, due, because the next, when we come to accrued income, there will be a slight change in this word only. Otherwise, the meaning is more or less same. So what is outstanding income? This is income earned, it is due, but it is not received. Means business has earned it. Business is supposed to receive, it is due, but the business has not received it till the end of the year. Such income is called as outstanding income. So once again, to find out the current year profit or loss, such outstanding incomes must be included because that is income of the current year. But only thing is we have not received it. If we had received, we would have shown it in the regular income. Since it is not received, it is treated as outstanding income. Now, it is receivable. Business has to receive. And since the business has to receive, outstanding income is an asset because business is likely to receive this in future from whoever is supposed to pay. Now, what is the journal entry? As we understand, outstanding income is an asset. So when I say outstanding income is an asset, outstanding income account, asset show debit balance, increase in asset is debited. So outstanding income account will be debited to concerned income account. So since this is an asset, outstanding income account will be debited. Debit assets always show debit balance to concerned incomes account. Income is an income, credit all incomes and gains. So income value will increase because that is income of the current year, though we have not received it. So adjusting entry for outstanding income would be outstanding income account debited to concerned income account. Question again, can outstanding income be given in the trial balance? And the answer to this question again is yes. In the higher accounts, you will learn that all these siblings that you are learning, whether outstanding expenses, whether outstanding income, the upcoming, say, outstanding prepaid expenses, income received, all these will definitely can be given in the trial balance. So let's focus on outstanding income. Yes, it will be given in the trial balance. Now, if it is given in the trial balance, then what about that value? Simple. Whatever value is given in the trial balance, that means that outstanding income amount is already added to concerned income. So if outstanding income is given in the trial balance, then the concerned income given is after adding outstanding income. So outstanding income has already been added to that concerned income. That's why if given in trial balance, you will have only one effect. Let's look at the application of outstanding income. So if given in the trial balance, as I just mentioned, you will give only one effect, and that effect will be on the asset side of the balance sheet, because income value has already increased in profit and loss account. You don't have to do it again. So only one effect, that will be asset side of the balance sheet. Now, if given as an adjustment, we are very clear, you will have to give two effects. One effect will be, since it is given as an adjustment, you will add it to concerned income on the credit side of profit and loss account. Profit and loss account credit side is incomes and gains. You will add it to concerned income on the credit side of profit and loss account. And the second effect, as usual, will be what you see above. It will be treated on the or shown on the asset side of the balance sheet. So this is about outstanding income. So I hope the concept of closing stock, depreciation, outstanding expenses, and outstanding income is clear. Along with outstanding income, regularly we find a word called accrued income. Now, let me be very, very clear. This word accrued in the subject of accounts is more so misused. I can also go to the extent of saying abused as well. Why am I saying this is, see, the concept of the word accrued is associated only with income, not with expenses, because you will find this word being used or the term having, accrued expense. There is nothing called accrued expenses in accounting, but few of the books may specify that. The concept accrued is associated with income only. Let's be very, very clear with this. Now, what is accrued income? If I go back to the meaning of outstanding income, it was income earned. In blue, it was written due, not received till the end of the year. Now, what is accrued income? See, this is income earned, not due. It is not yet due, and hence we have not received till the end of the year, and that's why it is called as accrued income. Now, what is this concept, earned but not due? Let's take a simple example. Let's take example of a bank. We have deposited money in the bank. Suppose bank is giving interest half yearly. Let's take calendar year for the bank. Bank is giving us interest, let's say on 30th of June and 31st of December. Bank is giving us interest on 30th of June and 31st of December. Let's imagine. Our financial year is from 1st of April till 31st of March. From 1st of April to 31st of March. Now, we in this particular year relating to current year, we are going to receive interest only in the month of December. We prepare our final accounts in the month of March, because the bank is going to give us interest only in the month of June. Whatever June month's interest that we have received this year is relating to last year. Remember this, only for the 3 months part. That's relating to current year. So we are going to receive full-fledged interest of the current year only in the month of December. Next interest will be received in the month of June, which will fall in the next accounting year. But now, when I come to 31st of March, we have earned interest for the month of January. We have earned interest for the month of February. We have earned interest for the month of May. We have earned, but has it become due? No, it will become due only in the month of June. So we have earned, it is not due, and therefore we have not received. Such income is called as accrued income. I said the concept or the word accrued is associated with income, and more so, it is associated with interest only. But you will find the word accrued with accrued rent, accrued insurance, and many other concepts that will be given over there, which is incorrect. The concept, the word accrued is associated only with interest. So we need to use this concept a little sparingly and not just misusing it or using it any time that we want. Now, accrued income, again, as I said, interest for the month of January, for the month of February, for the month of March, that is relating to our current year. We have earned it, but only thing is it is not due, so we have not received it. But we have to incorporate that in our profit and loss account to find the current year profit or current year loss, because it's relating to the current year. So we are supposed to receive interest. That's why accrued income is an asset, because it's likely to be received in future. Bank is going to give us interest in the month of June. In the month of June, 3 months interest will be of our previous year, last year, and 3 months will be of current year. So what is journal entry? Accrued income is an asset. Asset always shows debit balance. So the journal entry, adjusting entry will be accrued income account debited to concerned income account. So the difference between outstanding income and accrued income is just this. Outstanding income is income earned, due, not received. Accrued income is income earned, not due, and hence not received. So it's only about the timing difference that we talk about. But both are on par. Both are assets, and assets will show debit balance. So that's why the adjusting entry would be accrued income account debited to concerned income account. So the word outstanding will simply be replaced with accrued income. Rest of it, everything is same. Now, again, like I had asked a question earlier, can outstanding income be shown in the trial balance? Now I'm asking, can accrued income be shown in the trial balance? Answer to both the questions is same. It is yes. If accrued income is given in the trial balance, that means to the concerned income, accrued income amount has already been added. You don't need to add it once again in the profit and loss account. So if accrued income is given in the trial balance, then the concerned income given in the trial balance is after adding accrued income. So you don't have to do anything in the profit and loss account if accrued income is given in the trial balance. That means that concerned income, you have already added the accrued income value. You don't have to do it again. Let's look at the application. Accrued income may be given in the trial balance. If given in the trial balance, as you know, only one effect, and that effect will be on the asset side of the balance sheet. But if it is given as an adjustment, you understand all adjustments, double entry principle. So two effects. One effect will be you will add it to concerned income, that is on the credit side of profit and loss account, and the second effect will be asset side of the balance sheet. So the treatment of outstanding income and treatment of accrued income is same. There is no change. The change is only in the meaning. Outstanding income is income earned, due, not received. Accrued income is income earned, not due, and hence not received. So this is about the treatment of accrued income if it is given in the trial balance and if it is given in the adjustment. So if trial balance for any item, only one effect. If given as an adjustment, two effects. That is fulfillment of double entry principle. Now, so this is what I have as far as this session is concerned. The remaining adjusting entries that we have, that is from prepaid expenses to interest on drawings, we will cover that in the next part, that is basics of accounting part 14. So I want you all to stay tuned. For the time being, thank you very much. And if you'd like to connect with me, if you'd like to collaborate with me, you have my email and you have my phone number there on the screen. So thank you once again for your company, and don't forget to like, to share, and to subscribe. All right. Thank you once again.